Ever feel like you're playing a game you can't win? That housing is broken and your future is being sold out from under you? This is Paul Musson, and for 30 years he was a Bay Street insider, managing over 15 billion for one of Canada's largest investment firms. He knows exactly how the machine works. And now he's sounding the alarm. He says our leaders have been drinking the something from nothing Kool-Aid, creating a fake wealth effect. That's not just unfair, it's immoral. And it's an immoral transfer of wealth from your generation to the last. He calls it a capital offense, and he's here to expose why some people are benefiting at your expense.
This is going to be the first time in modern history, as far as I know, that the next generation is going to be worse off than the one that preceded it. This is, in my mind, completely unacceptable, and I believe it's immoral.
You're not going to want to miss this. Thank you. I appreciate you being on the show today, Paul.
Jason, thanks so much. It's great to be here.
I know you spent over 2 decades at McKinsey Investments and ultimately heading the Ivy team and managing billions of dollars.
Yeah.
What was the moment or the accumulation of moments that made you realize that the system that you had mastered was being steered down a treacherous path?
Yeah, I certainly had not mastered the system. And as any investor, professional investor will tell you, if they're being honest, investing is a very humbling business.
Mhm.
And you're going to get a lot wrong. You just want to get more right than you get wrong and make sure that the ones you do get wrong are not catastrophic and so small losses. So for me, it was probably in the run up to the great financial crisis. So that crazy housing bubble that was happening in the mid 2000s. And it was so obvious. And like, I wasn't the only one, obviously. There were a lot of people calling out this nonsense, what was going on. And that famous book and movie, The Big Short, it's about this, which I highly recommend. And it seemed that central banks were moving into territory where they had no business going, where they were trying to force people into a certain sort of behavior that they thought was going to be good for GDP, which is a measure of all final spending.
Mhm.
And so I got very frustrated watching Greenspan along with Bernanke, who the two heads of the U.S. Federal Reserve Central Bank, taking it after the dot-com crash. And after that very mild recession in 2001, it was only 1/4 of contraction, very mild. They took interest rates to 1% and kept them there for about 3 years. Completely reckless. But it was explicitly to drive housing prices higher and to create what they called a wealth effect. They're interfering in the marketplace. They're interfering with the price discovery mechanism of investors, consumers, with their own skin in the game, their own capital. They were trying to force different behavior because they thought longer term, it makes the government look good in the short term, but somehow longer term, don't worry, all the benefits will trickle down to everybody else. They didn't and they won't. And so that was the sort of the first phase of this is really wrong and arrogant. And then the response to the great financial crisis really confirmed in my mind that we were going down a really bad path. So first of all, bailing out all the bad decision making, bailing out all the reckless behavior. I believe that in large part, central banks were bailing out their own reputations by bailing out Wall Street, and then do even more of the same that got us into trouble in the first place by now launching QE and printing money and quantitative easing. And again, significantly hampering the market mechanism, the price discovery mechanism, which results in misallocation of capital and stuff like that, which we can get into. But yeah, I think those were the two main things that impacted me this is wrong and this is not going to end well. The problem is that a lot of policymakers, they're not bad people, good intentions. I do believe that, but they're very short-term focused. And they often, it seems, just focus on first order effects of their actions. So I do this, stocks go up. Okay, that's good. Let's go get a coffee. No,
Right.
you do this, stocks go up. What are the consequences 5, 10 years down the road? And the classic example, which I talk about in my book, is the former president of France, Francois Mitterrand, back in 1983. He lowered the retirement age in France from 65 to 60. He looked like a hero because, oh, he wants us to retire earlier. How nice. I want people to retire at 30. That makes me even nicer.
Yes.
I look like an economic genius because in the short term, nothing happened to the economy. Of course not. The consequences are 20, 25 years down the road where the burden of people retiring earlier than they should have is now put on the next generation and they've got to pay for it.
Mm.
It's that sort of short-term first order effect thing, which I think gets a lot of policymakers and economists into trouble. And it's not easy and it's not fun to think of the second and third order effects of your actions. First order effect, I'm hungry, I want a cheeseburger. That's great. Doing that every day. Guess what? I'm going to start packing on the pounds. Yeah, well, I'll figure out a way. I'll exercise more. And next thing you know, you're 30 pounds overweight or something. So it's not much fun to do that. You really have to force yourself to think of the second, third order effects of your actions, particularly when the first order effect is so positive and so
Yes, yes.
and makes you so popular and people are adoring your actions and every move.
Do you think it's incompetence or do you think it's a conspiracy? Especially, we have a lot of small business leaders that listen to this. And so when we look at what happened in 2019, 2020, 21 with shutting down their businesses or them barely making it and then their house prices going through the roof, like you said, what do you think this was purposely done? Is this just to make the good old boys make all the money? Because the stock market went through the roof during those times. Even now we're seeing, what is it, the ISM or whatever, where you can see manufacturing. Do you feel like the small business owner is the one that's catching it on the chin, and then these guys are just making tons of money? Or do you think it's just bad policy and that
Yeah,
they're
I
not
don't
even concerned about that?
yeah, I definitely don't think it's a conspiracy. I don't think it was bad intentions. And it's not about incompetence, if by incompetence or competence you're talking about intellect.
Mhm. Is it easy for us to quarterback it, like, after we've seen it? Like, we didn't know what they were going through at the time? Like,
Well,
talks about Jerome Powell and
yes and no, because it's all obviously it's always easier looking in hindsight. But there have been plenty of people warning about these sorts of actions for many years because it's based on what I believe is sound economic theory, what works and what doesn't work. And I believe that most politicians, not all, but most, don't really understand what makes an economy tick, what makes an economy thrive, what's really required, because they've been convinced by some economists who are they're more ideologically driven than the true laws of economics driven.
Mhm.
So it's called, I think they refer to it as normative economics, economics as you wish it would be. So we can have our cake and eat it too. So we can have a free lunch. And so they put forth these theories and formulas and calculations and show this to the politicians. And it tells the politicians that debt and deficit don't matter. So go ahead and spend like crazy. That's exactly what they want to hear. So they think they're doing the right thing or not. The laws of economics are what they are. And ever since I was in my early 20s, I decided that I was not going to kid myself. I was going to live a face the music life, right? I'm not going to be ashamed of my own feelings and whatever or what I've done. Like I'll just admit to myself what I'm feeling and then deal with it, not be
Mhm.
embarrassed about it, right? And then move forward thing. And it's not easy to do, right? It's not easy to be brutally honest with yourself. Okay, wait, maybe I'm not smarter than everybody else. Maybe I do need to work a little bit harder. Maybe I don't know what stock markets are going to do, so I'll have to be a bit more careful with my client's capital, all this kind of stuff. And so, about 15 years ago, I just started studying economics because I wanted to build a foundation of truth of what are the real laws of economics. But some people don't like it because these laws can be very inconvenient. And so some economists, they liken getting angry at the laws of economics, they liken it to getting angry at the law of gravity and blaming gravity crashes.
Mhm.
No, it is what it is. And so I think that's the main issue, that it's not easy being in charge. In terms of the term, anyone who's been in charge knows that it's not easy being in charge, and it's very easy to be the critic on the side. And in terms of the actions during COVID, I'm definitely not a conspiracy theorist with respect to COVID. Not to say that there isn't one. I just don't believe it, or I just don't see it. I think it's possible. It could be. I really don't know. But so I give policymakers a pass when they close down the economy. I know some people are furious that they did that, and I understand why they're furious. And it was a huge decision to make. Um, Going back to that time, it was a scary time. And I
Yeah.
was it
Yes.
going to the grocery store, coming home and wash my hands 15 times, just worried. Now, maybe they made us worry unnecessarily or too much. I don't know. It was scary. But what, in my opinion, what was stupid was after you shut down the economy, so people aren't producing anything, you then send people stimulus checks to go and buy all the stuff that's not being produced.
Right. All the QE.
It's almost silly. Again, it's part of the problem there is that so many economists and politicians think that consumer spending is the fount of all economic prosperity because consumer spending is about 2/3 of GDP. GDP is all final spending, right? Government, investment, net exports. And so as the consumer's 2/3 of that, they think we just got to keep the consumer spending to keep the economy humming. No, that's not what drives an economy forward. What drives an economy forward is what gives those consumers the wherewithal to buy things.
Yeah.
Where did they get the money? So it's very important. This goes back to an economist in France back in the early 1800s, Jean-Baptiste Say. And he said that when you produce something, paraphrasing, this gives you the wherewithal to go out and demand something from someone else, right? So saving and investment comes first, and now you can go and consume. It's not the other way around. And yeah, anyway, so that's,
Do you feel like, because obviously you see stimulus checks going out, quantitative easing, rates being at almost zero or zero, whatever they were. Then you see, what are we, trillions of dollars in debt now? But then now we have Scott Bassett and others are saying we need to spend our way out of this. How does that look? Do we have enough growth that's happening, whether it's with AI companies or think technology is going to save the day? Because we can't even, like, the interest rate alone, right, on the debt that we have is through the roof. Why do we have this, whether it's Democrat or Republican, especially in the United States, why do we have this thing where we think that we can just keep spending?
yeah. It's a good question. And as I mentioned in my book, these issues that we are facing transcend politics because
Mm.
it happens no matter who's in power. And no, you cannot spend your way out of trouble or out of a slowdown. It will make that GDP number temporarily look stronger because how could it not? If you're spending and GDP is a measure of final spending, how could it not look better? The analogy I use in my book is if your neighbor, you look at how much they're spending, and every year they buy a more expensive car, another addition on the house, another vacation. That's their GDP, their final spending. So you think to yourself, wow, my neighbor must have a great job producing a lot of capital. We'll get into capital and money after.
Yes, yes.
Producing a lot of capital and contributing to society. And now they produce this capital, it gives them the wherewithal to go out and spend. So their GDP is very strong and every year is growing. So, well, yeah, that's good. But if their GDP is a result of them taking on more and more debt to fund that spending, then your neighbor's balance sheet and your neighbor's economy is not quite in as good shape as you thought it was. Eventually, that spending is going to stop. right? Because they won't be able to access any more capital. Nobody's going to lend them any more money, or they can't service any more debt. That's when the central bank will come in and lower interest rates. So the interest rate on your neighbor's debt will go down so they can service more debt, take on a bit more debt, spend a bit more money, keep it going for a little bit longer until it just can't go on any longer.
Now, I mean, that because that eventually affects the dollar, and then in turn, you can also see, I mean, we've got our credit got downgraded. So there's is there a long term? So let's say you have a business owner, he's in his 30s, he has a business. Obviously, when I look at it, it's I don't want any debt. I don't want to have debt. You know, I mean, if the rates are low, I get it, depending on, but I want to keep everything in a balance. Obviously, that's basic. Looking at my balance sheet, that's just basic. I want to make sure I understand that. So why do we feel like we have a pass with the government? Why is the government allowed to just double or triple what we were spending? I've seen the charts where it is from 2017, 2018. We've had different presidents and it's just going straight up.
Again, you're getting those people out there who are saying deficits don't matter, right? So it doesn't
Yes,
matter.
right.
The government takes on more and more debt as long as you're a monetary sovereign, as they call it, where you can print your own money. And as long as we can print our own money, then we can never default on our debt. That's true. If you lend 10,000 to the government and they're just going to print money to pay you back, you'll get your $10,000 back, but it's going to be worth a fraction of what it was
All
when
right.
you first lent it to them because they've extracted capital from your money. Yeah, it's just very easy for politicians to believe this. And the main issue is the entitlement spending is huge in the US.
Mhm.
And nobody wants to touch it because it's political suicide. And so if you look at Social Security, I believe it's early 2034 now that it will be insolvent if no changes are made.
Mm.
And for decades, people have been taking out of Social Security more than they put in. And I think the total funding is something like 13%, so it's 6.5 tax on your pay, and your employer pays 6.5. Self-employed people pay 13, I think. But for most people, it's still not enough to fund your future retirement benefits. Because when populations were growing, it wasn't an issue because you had a growing workforce to fund the retirement of the baby boomers, not baby boomers, this is ending it, but the previous generation. And I talked about this in my blog before. You know, it might seem a bit extreme for people, but I believe that each generation should fund itself,
Mm.
whether it's housing, which we'll get into, whether it's entitlement programs, that we need to be funding ourselves. We need to be self-reliant within our own generations rather than pushing the burden down onto the next generation.
What time frame do you do that, like 20 years, 30 years, like, or a generation? How are you looking at that?
Yeah, I don't know. Boomers, Gen
Mhm.
X, millennials, this is standard. I don't know how many years there are between each. There, this, the way the economy is supposed to function is that through saving and investment, that companies can improve their products or improve their production techniques so that they can make the same product cheaper, make them better. And then as long as you have freedom of competition, as soon as companies start improving their profit margin because of that investment, other companies come in to that industry to compete away that excess profitability. And so
Mhm.
the incumbent has to lower their prices to remain competitive. And so prices should be falling on a regular basis. Basically, policymakers will tell you we need 2% inflation for an economy to grow. It's nonsense. There should be deflation. It's called good deflation. And I'll get to the generation thing in a second. So, as per example, in the last 30 years of the 1800s in the US, from 1867 to 1897, the money supply only grew just over 4% or so. Yet there was an explosion of productivity. And so you had prices falling for 30 years, consumer products. So even if you had a flat wage, you were becoming wealthier every year.
That makes sense, yeah.
And you're benefiting from all the innovation that's going on by entrepreneurs doing all these incredible things, should always be the ultimate beneficiary of that, right? But it's not happening anymore because now central banks grow the money supply much faster than the amount of stuff being produced in the economy. And it's gotten worse. So not only is that not happening, but because of the entitlement programs where we're taking more out than we're putting in, this is going to be the first time in modern history, as far as I know, that the next generation is going to be worse off than the one that preceded it.
Hmm.
And this is, in my mind, completely unacceptable. And I believe it's immoral, right? I know why it's happening. And I think a lot of people don't know why it's happening because they don't want to know. And there's a saying, and I put in my book, Upton Sinclair, he was a socialist back in the 30s. He said that if someone's income depends on them not understanding something, then don't expect them to understand it. They don't want to, right?
Right.
Just bounces off, whatever, let's get on,
Mhm.
because they're pleased with themselves. I don't know who isn't pleased when you're making a fortune, either on your house or in the stock market, but you didn't really earn it. You just got lucky. When the stock markets soar, then you put it down to your own investment expertise. It's stupid markets.
Do you feel like, because I know in your book, and I want everybody to get it, we'll have the links in the show note, Capital Offense. Do you feel like, and I know you talk about this, and I think it's really important that people understand this, and you just mentioned it, the difference between money and capital.
Yeah.
And can you break down this distinction and explain why confusing the two has been such an issue and catastrophic?
Yeah, I know. And I have a quote in the book from John Kenneth Galbraith, who talks about the issue of money being one that was purposefully made complicated, keep people in the dark. So it's not money that makes the world go around. It's capital. All like what your listeners are doing on a daily basis, the capital they produce, either a good or a service that somebody else values. That's what makes the world go round. But we don't have a barter system. We don't have a system of direct exchange because it gets very complicated once you have more than a few goods. So,
Mhm.
example I use, you make a bike and I make a suit. We have each just created capital. Now, just because there are only two of us, we can do a direct exchange. We don't need money. We can do a direct exchange. I give you my suit, give me a bike. We're both better off. There was no bike and no suit in the economy beforehand. You and I got to work, created that capital, exchanged it with each other, and it didn't come at anybody else's expense. That's really important. Capitalism and a free market system, whatever wealth you have should never come at somebody else's expense. It should only result because somebody else has benefited from what you've done. So whatever material wealth you have is supposed to be a reflection of material wealth out there cumulatively that other people have.
Right.
You're both better off, not at the expense of somebody. Increasingly, I'll finish on it in a second, but just what we're experiencing now is a benefit at the expense of somebody else. And it's made possible largely by central banks. And I liken it to a game of poker. Well, there's nothing wrong with the game of poker because everybody knows going in that when they go to the table, there's no capital creation at the table. There's a redistribution of capital at the table. And at the end, one winner and a bunch of losers. Could sound familiar to a lot of young people in our economy today. To capital and money. So because we have so many goods, you can't possibly have a barter system. So we exchange the capital through what's called a medium of exchange, which is simply money. We use money as the medium to exchange all the goods that we're producing. So you make 10 bikes and you sell them for $1,000 each. They're nice bikes. And you don't want to spend the money right away. Central banks want you to, but no, you're ignoring the pressure and you keep it in your bank account. And you're going to spend it at the end of the year, go on a nice vacation or something. But before you get a chance to spend your $10,000, and by the way, that $10,000, what it represents is the 10 bikes that you produced. You've stored 10 bikes in your $10,000 in your bank account.
Mm-hmm.
That's what gives it purchasing power. So before you get a chance to spend your $10,000, the central bank doubles the money supply. Now, when the central bank prints money, it didn't have to create any capital to get that money. It just printed it out of thin air. So it's got no capital stored up in it. It obtains capital as soon as it comes into circulation, extracting capital from the rest of the money that's already out there.
Mm.
So as soon as that doubling of the money supply goes into circulation, it extracts 5 of the bikes from your $10,000. So now your bank account still says that you got 10,000 bucks in the bank. That feels good. But guess what? Instead of storing 10 bikes, it only stores 5. And so now your $10,000 will only buy you half the vacation it would have done before the central bank increased the money supply. And that's the way I think of the difference between money and capital. You could have all the money in the world, but if there's no capital to exchange, it's worthless. You could have lots of capital and no money. You'd still have an economy, not much of one, because money is very important in terms of the role it plays. But it's capital. That's what makes the world go round.
Yeah, that's so great, Paul. I remember I was in Somalia. I was in the Marine Corps, and we would walk around and kids would give us stacks of Somalian money.
Really?
And they would want like $1 from us, but
Yeah.
they would give you literally, they had money. It was worthless, but it was a huge stack of money and they all had money all out because they would just run around and try to, there's a lot of orphans and stuff there. They would just run around and try to earn money. But it was so interesting what you're saying there because there's no capital there. Like it's broke.
And it reminds me of the German hyperinflation of 1923. You know,
Right.
those famous pictures, someone full of cash to buy some bread or something. But it got so bad that companies started paying their employees like 2 times a day or something like that. So people could paycheck in the morning now and spend it as fast as you could, because if you waited to the end of the day, your paycheck could be worthless. The inflation was so ridiculous.
This is where it gets me. And like I said, we don't have to be political here, but I don't care if you want to or what, however, total freedom of speech on this podcast. But what worries me is what happened in Germany to the younger generation. And then what they began to think, what they began to, how angry they got. And we're starting to see this here in the United States, the same mentality. We're seeing it in New York City right now with what's going on with socialism. But over and over again, this younger generation doesn't know what the hell to do because this has just been thrown on them, if that makes sense.
100%. And as I said earlier, the issues transcend politics. And because it's just my belief anyways, that these monetary policies, or this monetary policy and a fake wealth effect and printing money and extracting value and winners and losers and benefiting at the expense of somebody else, this is one of the main causes, if not the main cause, of the divisiveness within society. America, unfortunately, may be leading the way in that regard, but Canada, we're not far behind. UK, everywhere is happening.
South
Because
Korea, right?
we're all doing the same thing. Yeah, we're all doing the same thing.
Japan, all of them.
Yeah, and young people are the ones who are most negatively impacted by this. And it's hard for people to connect the dots because economics, like any field of study, speaks a slightly different language, a language that a lot of people can't understand, terminology they don't get. Complicated for me to understand. That's why I wrote my book in very easy to understand terms, lots of analogies, take it step by step. If you read it, you will get it, right? But on the surface, it looks very intimidating. So people don't study it, don't figure out what's happening and why they're suffering. And so then it becomes very easy. The easy way out, the easy thing to do then is for Republicans to blame Democrats and Democrats to blame Republicans. It's conservatives versus liberals. Yeah. And then the leaders come forth that will foment that anger. And yeah, let's go. And none of the participants, I guess, as I said, are bad people. I don't believe that. But bad systems and bad, just like in a business, like your listeners will know, if you're in an environment where there's a bad corporate culture, that can really bring out the worst and
Mm-hmm.
very good people.
Yes.
And,
100%.
and I've been there, but I've had my not fighter moments based on fancy. I blame the situation, not me. But yeah, that's what's happening.
Yeah, I want to get into because in your book you talk about something from nothing Kool-Aid. These policymakers have been drinking. Let's get specific. Let's get into the housing boom. And it makes me feel wealthy because my house doubled in the last I'm 52. So, my house doubled, but actually what you talk about is like a hidden tax or a wealth confiscation for the younger generation.
Yes, exactly. So I'm 63. So
Mhm.
it's a decade older than you. And so my house is appreciated a lot more than yours.
Mhm.
And so I'm extracting way more from society than you are. Now, neither of us have broken any laws by the rules, worked hard, paid a fair price for our home. But particularly in my case, when we bought our house, we bought it in 2001. And it just happened to be when central banks, starting with the Federal Reserve, decided to create a housing wealth effect and drive housing prices higher. And then the Bank of Canada followed suit, Bank of England, the European Central Bank, everybody driving house prices higher. Now, earlier, now house prices should not be going up. They should go up with general inflation. There shouldn't even be general inflation. There should be deflation, like I talked about earlier. But given that they do increase the money supply so much, if house prices just went up with inflation, it wouldn't be a bad thing.
Mhm.
The inflation would be bad. Housing would fall away. So earlier I said that the way a free market system is supposed to work is you're only supposed to benefit to the extent that you've benefited somebody else because you created capital in exchange with someone else. So now you've got their capital and they've got your capital. So when our house from 2001 is up 4 times from what we paid for it in nominal terms.
Mhm.
Just for inflation, it's about 2.5 times. So what was in that situation, what was our contribution to society to justify us making 4 times on our home? What was the capital that we created that
Mhm.
were 4 times what we paid for our home? There's nothing. We didn't do anything. So if you're getting more out of the system than you put in or that you contributed in exchange, then it has to be coming at somebody else's expense. There's no ifs, ands, or buts about this. Our house is the same economic good as it was back in 2001.
Right.
It's 4 times the price, but it didn't increase 4 times in size.
Right.
It's not producing 4 times as much stuff. It hasn't relocated to a better location. I
Mhm.
don't think it's wrong. It's the same economic good. So it's a redistribution of wealth. No capital was created when we earned 4 times on our home. All it is, you down on it from a societal perspective, there's a redistribution of wealth from a younger couple's bank account or a newcomer to our country, from their bank account into our bank account. So the same amount of capital, but just more of it now is in my bank account rather than a younger person's bank account.
But
So
even, like, rent is still through the roof for a lot of people too. Like, they can barely even not even a house payment, but they can barely even afford because the rent went up when the housing prices went up.
so here's another really terrible consequence of driving housing prices higher. A number of consequences. First of all, people see the house price going up. And so they rely more on their house for their retirement and save less than they would have done otherwise. And they
Right.
consume more, which is exactly what policymakers want them to do. But if they're saving less and investing less, then there's less stuff being produced than there otherwise would have been. But we're worse off that way. And that's the unseen, what you don't see that would have been there if they hadn't driven house prices higher. The other issue is that just because housing prices are rising, for some reason, it seems to get more expensive to run government, so they raise property taxes. No. If anything, property taxes should be going down as a percentage of house prices as economies grow. There's economies of scale there, technology improvements. It happens in the private sector, but I know there are some good things that are going on in government. Don't get me wrong. I'm not trying to demonize government people, bureaucrats, a lot of hardworking people, smart people. But increasing property taxes, to me, that makes the rent more expensive because whoever the landlord is, their property taxes have gone up and they have to put that down to their tenants. And I know people who are facing some tough decisions because of this. Retired, stable cash flow, but the rent keeps going up because property taxes are soaring. Why are property taxes soaring? I know why. They shouldn't be.
It's what's sad too is this younger generation doesn't have the opportunities. Like I can remember my father, my mom never worked. It was just my dad working, and we were middle class, and he was able at a young age to buy a house. It was like a 3-bedroom, 2-bath, typical Rambler type house, but with one income, he was able
Yes.
to do that. There was an opportunity, one income, he was able to do that. They went to the schools, and then that created stability, and the opportunities have gotten less.
Yeah. And it's simply because this of this what I call fallacious economic doctrine, where if you drove housing prices higher, somehow the benefits would come to the next generation. They haven't. It ruined the lives of so many people. And it's getting bad in the US. It's much worse here in Canada. It's much worse in Australia. The average income to the average the average house price to the average after-tax income in Canada for 30 years went in a range of about between 6 and 8 times, say 7 times. But you can see on a chart, it's like that until about 2001 when the Fed started their housing wealth effect policy, and it just starts to relentlessly go higher and higher.
Mm,
And we're up to 12 times now. Never mind the mortgage payments, trying to come up with the down payment
right.
for an average home now. It take years. People have to start their families way later than we did because they can't afford to. And another earlier when I was talking about, so with us, 4 times what we pay for our house. So if you have a house, it's for savings, right? When you buy a house, you have a mortgage and you build your equity in your home by paying off the mortgage. So if you made bikes for a living
Hmm.
and now you've paid off your mortgage, your house now, mortgage free, essentially the value of that house is all those bikes that you made throughout your career. So all these bikes up. And so then let's say a nurse comes to buy your house. She's going to borrow money, or he's going to borrow money, and then hopefully pay that off. And they would have their nursing services stored up in that house.
Right.
But if you get twice what you paid, you're getting all those bikes that you made that's have your value, and then you're also getting nursing services from her without giving anything in return.
Mm.
You know,
Yeah.
it makes things confusing there. Story.
No, you're exactly right. But what happens if you're a young couple and both of you have student debt? So on top of it, now you can't buy a house with that much student debt.
Yeah.
And we can go into whether they should have done it or not, or if they'd have been, but 18, 19, 20 years old, it's just dismal if you look at the next generation. And what I want to get into, because I know you argue inflation is a hidden form of wealth transfer,
Yeah.
where most leaders were taught that a little inflation is good and it's necessary. Can you challenge that assumption for us and tell us who really benefits from inflation?
Yeah. So first of all, the inflation is a lot higher than the government statistics will tell you it is. And they use certain techniques like hedonic adjustments.
Mm, mm,
So if a product is going up in price, but it's improving in quality, the government will say, no, you're getting more product than you did back here. So the price is really down here, even though you're paying more. An example I use in my book, forget the exact year, 96 to 2008 or something like that. Car prices were up, let's say 50% over that time. But according to government statistics, they actually fell over
mm.
that. kept reducing the price because cars were getting higher quality. No, you shouldn't be doing that. We should be benefiting from that higher quality and paying lower prices, like I told you earlier. So governments benefit from inflation. So so I said earlier, if you lent money to the government, $10,000, and they increase the money supply, then they'll pay you your $10,000 back, but it'll only have half the capital in it.
Mm-hmm.
So you got screwed and they benefited because they're borrowing the money, spending it today and paying you back a fraction of what you lent them in real terms. So anyone who has debt benefits when there's inflation. And who are the biggest debtors in the world is governments.
Mm-hmm.
And helps people that they're not going to touch their entitlement spending and all this kind of stuff. And so then they come up with these wonky excuses for why we need 2% inflation, because we need what they call animal spirits. Like, first of all, animal, really? No. People we're humans. We make informed decisions, smart decisions. People are very smart. The average person is very smart, and they make very well informed decisions, particularly with their own capital, with their own skin in the game. Governments don't, because it's not their skin. The only skin they have in the game is yours. It's in capital. And government spends either on infrastructure or government services or whatever, government salaries. All that capital comes from the private sector. So it has to first be produced in the private sector, and the government gets that capital either through taxation or borrowing or printing money. Printing money extracts the capital without your permission. The first two lending comes with your permission. Taxation, you might not want to pay your taxes, but you'll end up in jail if you don't. So they will tell you that inflation is required for an economy to grow. No, it's not. And so some refer to something called the paradox of thrift. And so, Jason, if you save your money instead of spending it, in their mind, you're denying somebody else an income. So if you don't buy my suit for $1,000, then you just denied me an income of $1,000, and I may have to lay off whoever's working for me because you're not consuming. And then person that I laid off, they won't have money to spend, and so then somebody else will have to lay somebody off, and then it all goes down to a spiral. It's complete nonsense. And so the example I use in my book is, okay, so they want inflation to encourage you to spend your money before prices go up. Well, I better buy that bike before it becomes more expensive next year. And by the way, when you save your money, it doesn't mean that it's not spent. It's spent further up the value chain in the economic system in more intermediate goods. So you're saving your money, it gets invested, but that doesn't get caught, intermediate goods doesn't get caught in the GDP number because the intermediate final spending. There's another term called gross output, which some people look at. Anyways, so they say that if we need 2% inflation to encourage you to spend your money and provide me with an income, and that if inflation is 0, then you've got no reason to spend your money. How stupid is this?
Exactly.
Well,
Yeah.
Yeah. So then I use the example of, let's say there's 2% deflation. So falling
Mhm.
prices. So this is a central banker's nightmare, right? That the whole economy now is going to spiral down the toilet because nobody's going to spend their money and provide others with incomes. So the example I give is a TV. So let's say you've already got a TV and you're thinking it'd be nice to have another TV in the basement so my teenage kids could go down there rather than being up here and causing a racket or whatever. So TV's $300. You got 2% deflation. So a central banker will think Jason's not going to buy that TV because he's going to wait for lower prices next year. So are you going to wait 12 months and spend $294 and save yourself $6 rather than spend 300? Okay? And it's a
Exactly. Yeah.
luxury item. This is not even a necessity.
Yes. Yes.
So like theories on the surface, oh yeah, it makes sense. As soon as you scratch them a little, often they're complete nonsense.
What do you feel about with banks and rates and inflation? Because I know, don't they benefit off of it?
Banks are lenders. So to the extent that, they're going to factor in interest rates into or the inflation rate into the interest expense that or interest charge they're going to charge there
Right.
going forward. So I'm not sure. Where they do benefit is from low interest rates and quantitative easing. And so low interest rates enable, so central bankers would tell you that we're only trying to make housing more affordable by driving interest rates to zero. No, low interest rates do not make housing more affordable. Temporarily, they make mortgage payments more affordable.
Yes.
They make housing way more expensive. Yeah, but again, it's that short-term, first-order effect way of thinking.
Because I imagine if the rates get really low, like what they're wanting to do next year, it's going to boom. There's going to be a housing
Yeah.
shortage, right? Won't everybody want to be getting into a mortgage because they're just going to look at what the monthly payment is?
Yeah, exactly. And yeah, no, it's just very frustrating. Um, yeah, it's just not going to end well. Unfortunately, people just don't like hearing it, and so they continue kicking the can because dealing with the issue is not going to be very popular,
Mm.
and it's going to come at a cost.
Do you
And
feel
then,
like, oh, sorry, go ahead.
no, I'm just going to say that the reason I wrote the book and the reason I have my blog, Political Economy, is that I'm trying to empower people with the truth.
Mm.
So I think the average person is very smart, particularly with their own capital. Empower people with truth understanding. And so that they can then demand better decision making, better policy from our leaders. And once we demand that, they will do the right thing. Our leaders are not bad people,
Mhm.
but they're going to do what we demand of them. We've been convinced that you can have a free lunch, that everybody deserves to get a pony and buttercups and rainbows forever. No, it's hard work. You have to work for your
You
capital.
have to make the bikes. Yep.
You have to make the bikes. And so they believe in this sort of something for nothing myth. And we've believed in it. And so we've demanded they keep giving us freebies. They're obliging. They'll only do the right thing when we demand it of them. And then also, it's really important that we do decide to try and fix this. Usually, the only way you can fix something is once you have a crisis. If someone's got a bad lifestyle, it's only after they have a heart attack that they change their
Mhm.
lifestyle.
Yes.
If they're fortunate enough to survive it. And we will survive the next crisis. But there's an old saying, don't waste a good crisis. Because when you're in crisis, everybody's suffering. And what have we got to do to fix this? I'm willing to go through some hardship for a year or two, tighten our belts. But they have to know and have to believe that we're all in this together. And it's not just people don't trust the leaders anymore. Think I'm going to be the one suffering, where they're going to be fine, or the other side are going to be fine. But if people know, and especially in America, America can really rally, and that patriotism is awesome. And I think it's going to happen. I really do. But there's going to be some pain before we get there.
Do you think, 'cause I wanna we're coming up on the hour, so I wanna make sure I'm respectful of your time, but I do want to we have a lot of listeners, and they'll ask me, and I'm like, "I'm no financial advisor." And you're perfect, you're an expert in this arena. But you've got somebody that may be 35, 40 years old, maybe they have a little bit of money left over at the end. They have a business, they have a little bit of money left over at the end of the month. If we're in a fake wealth effect, and if this has artificially inflated this market, what's the like, for the retail investor, what's the number one thing they can do?
Worry.
That's
My investment team, our name was Ivy. So instead of buy and hold, our investment style was buy and worry. That's what we said.
Oh, it's
You know,
good. That's the
because
truth.
something could go wrong at any time, and so many people are relying on you to help augment their future financial security, worrying, and especially because
Fresh.
there was war.
Yeah.
Our investment model was at Ivy, we lose here, so you don't have to.
Oh, that's so good. Yeah, yeah.
Yeah. I think the first thing that people should do is just be aware of, to the extent that they can, of what's going on. And that when stock markets are soaring,
Mhm.
it's no longer really a an indication of how strong the economy is. Now, in the past, there were always speculative bubbles and stuff like that, but there was always something behind it. In the 20s, you had the roaring 20s, and productivity growth was soaring, real wages were growing nicely. Stock market soared and got carried away, in part because of really easy fiscal or monetary policy by the Fed. Likewise, the 90s, but the dot-com growth really grew strongly in the 1990s. Greenspan kept rates too low for too long, whether it was a result of Y2K fears or whatever. But in 1998, 1999, stocks soared again, got completely carried away. It used to be that stock markets were somewhat reflective of what was going on in the economy. And not so much anymore. There's still a lot of good stuff going on, don't get me wrong.
Mhm.
Over the last 15 years, when Bernanke started this whole QE, buying assets to drive asset prices higher, and this is not a conspiracy theory, they will tell you that's what they were trying to do through what effect. And so it got to the point, and it's still to some degree, that when there was bad economic news, stock markets would soar because that meant that the Fed would lower rates or print even more money.
Yes.
And when you lower rates, we haven't really talked about this, but just briefly, there's something in the economy called the natural rate of interest. And the natural rate of interest is determined by market players in the economy making investment decisions to borrow or to lend, their own capital, their own skin in the game, assessing the risk of the other party. When you have millions of parties doing this, it results in a naturally determined market rate of interest, which is the one that results in the greatest productive capacity of the economy, right? It's a natural rate. There's another thing called the neutral rate of interest. This is what central banks focus on. This is the rate of interest that will drive spending, GDP, without causing too much inflation. Now, they've encouraged debt fueled consumption for years. So when people are taking on more and more debt and governments take on more and more debt, it gets to the point where you can't service any more debt. So it starts to slow. What does the central bank do? They lower the interest rate so people
Mhm.
can take on more debt and spending starts to rise. But then they hit another debt ceiling. Oh, we better lower the interest rate again. Every time they lower the neutral rate, they're lowering it further and further below the natural rate, which is the best for the economy. So productivity growth has been grinding lower, more or less, for decades in the US. It's like non-existent in Canada. So and because they wanted to drive spending and asset prices
Mm,
higher.
mhm.
And so in my mind, they have sacrificed the real economy, central banks have, on the altar of higher asset prices, both stocks and houses.
So what would you to close? What would you do if you're an entrepreneur, if you're a CEO of a small company? How would you look at the market? How obviously we're gonna have lower rates, we're gonna have a little boom. That seems pretty predictable, like what's going
Well,
on now.
yeah, the problem is that you never know what's going to happen.
Of course.
You never know I think I know what's going to happen roughly,
Mm,
but timing it is impossible, whether it's weeks or years.
mhm.
It's impossible to know. And there are a number of different outcomes that could happen. But generally, sound businesses, I've analyzed businesses my whole career from all over the world, some of the top businesses, highest quality management teams. It was a great job. But what they all seem to have in common was this humility that they're very focused, obviously, first and most of all, on the customer value proposition and not trying to figure out what the economy is going to do next year, what stock markets are going to do, what interest rates are going to do, because you can't figure it out. You can put together a story that sounds fantastic. Oh, this makes so much sense. Of course it's going to happen. Then someone else
Right.
can tell an equally convincing story that's just the opposite.
Right.
And so these companies would never position their business assuming that they knew what was going to happen in the economy. They position their business knowing that they don't know what's going to happen.
Mm.
And so they're more careful. Now they invest like hell in their customer value proposition, relentless you wouldn't want to compete with these people. Like just incredible, so impressive. But like you were saying earlier, if you have a business, the first thing you want to do is get rid of your debt.
Mm-hmm.
Because what if the economy tanks and my sales go down 50%? Am I going to go bankrupt? Or like, you do have the Bank for International Settlements at a report, this is before COVID, something like 17% of listed businesses in developed economies are zombies. So they have enough operating profit to even pay the interest expense on their debt. And they're only still alive because of central bank policy. So central banks bail those companies out so they can continue to destroy capital. So you might be lucky if you take on too much debt and the central bank might bail you out, but then you're destroying capital.
Mm.
So maintain a strong balance sheet, keep it real. And if you want to be invested, and it's just my style, I can't give personal investment advice. I'm not licensed to do it. I don't think I'm very good at it. I think was a good investor, but just the old stuff that I think really works is be diversified in stuff that is extremely high quality, whether equities, bonds. I've got a little bit of gold. Don't get too far over your skis on anything. And it doesn't have to be complicated. And,
Right.
and if markets soar and the economy is strong, then you're going to benefit as long as you've got that customer value proposition going. If it all goes to hell in a handbasket, you'll probably survive it. And a lot of others won't.
Yes.
And there's
Yeah.
an
Exactly.
opportunity for you to take market share because you were careful.
Mm.
That's just the way I invested that way. I've lived my life that way. It's the only way I know how to do it because I'm a
Really?
worrywart. Yeah. And there's nothing wrong with risk as
Right.
long as it's appropriately priced.
Yeah, that's so good. That's great. Paul, I want to extend a sincere thank you and just appreciate your wisdom and joining us today. And you brought clarity, and I know your book's this way. That's why I encourage everybody to purchase your book, and the link will be because these are complex, and I think for a lot of people they can be intimidating. But these subjects, and today I think you've opened our eyes, and for me, deeply challenged me. And so I want to express gratitude to you and thank you for taking the time. Obviously, to take something complex and make it simple, that's really hard to do. So I want to thank you for that, and thank you for writing the book.
Thank you very much. And thank you for all the research you did before this and the questions. It's really appreciate it.
Yeah, and it's capital offense, why some benefit at your expense, right?
That's right. Yeah.
And I want to make sure that everybody goes and sees your blog. It's well known. Your blog. It's Paul, and then what's the rest of it?
So it's instead of political economy, it's political economy. And it's free. And it's a weekly blog I send out. And all my old past blogs and interviews and stuff are on my website, which is paddingtoncapitalmgmt.com.
Thank you, Paul. Appreciate it.
All right, Jason, thanks so much.
Ever feel like you're playing a game you can't win? That housing is broken and your future is being sold out from under you? This is Paul Musson, and for 30 years he was a Bay Street insider, managing over $15 billion for one of Canada's largest investment firms. He knows exactly how the machine works, and now he's sounding the alarm. He says our leaders have been drinking the something from nothing Kool-Aid, creating a fake wealth effect. That's not just unfair, it's immoral. And it's an immoral transfer of wealth from your generation to the last. He calls it a capital offense, and he's here to expose why some people are benefiting at your expense.
This is going to be the first time in modern history, as far as I know, that the next generation is going to be worse off than the one that preceded it. This is, in my mind, completely unacceptable, and I believe it's immoral.